Are the US Fed rate hikes triggering a global recession? Yes, that would seem the most obvious answer considering that capital and money markets across the world are in a tailspin. By announcing its third consecutive interest rate hike on September 21st, the Fed has sent a clear signal that it does not intend to play ball with other global economies, a move that has been further reinforced by the strong surge of the greenback against all major currencies. There is no denying the fact that global bond and stock market values are shrinking rapidly. According to a report in Japan's Nihon Keizai Shimbun, global stock and debt markets saw their value plummet by a cumulative $44 trillion. But the US does not seem to be in any mood to prop up the markets. The Wall Street Journal says that despite the rising risk of global financial turmoil, US policymakers will not take any steps to slow the rapid rise of the dollar, as a strong dollar is a prerequisite to curb the high domestic inflation. There is no denying the fact that the US dollar has seen its value surge as the Federal Reserve keeps raising interest rates to fight the worst US inflation in decades. And investors keep moving money into dollar-denominated assets, the report said. The Wall Street Journal Dollar Index, which measures the dollar against a basket of other currencies, has risen about 16% so far this year. The report argues that the strengthening of the dollar relative to other currencies has put pressure on many other countries, pushing up the cost of importing dollar-denominated goods and servicing dollar-denominated debt. In the new report, the United Nations Conference on Trade Development said that each percentage point increase in the Fed's push to hike interest rates will lower the economic output of other rich countries by 0.5% and the economic output in less developed countries by 0.8% over 3 years. That's because a strong dollar makes it more expensive for other countries to import essential items like food and fuel. An elevated greenback especially crushes poor countries that must meet their debt obligations in dollars. Cornell University economist Answer Prasad said that even though these risks are increasing, the US will not slow interest rate hikes or otherwise change the dollar's trend unless it poses an immediate risk to the country's economy. So far, the risks to the US are limited and the benefits are tangible. According to Bloomberg News, the world economy is showing signs of a rapid decline as it copes with a series of shocks.